2025 was a positive start for both growth and defensive assets. Equity gains were led by Europe, followed by the UK. This was driven by value companies performing well, reversing the recent trend of growth stocks dominating returns. The UK performance was also helped by a depreciating currency over the month. So starting with the economic picture, the US economy still appears to be in good health, with 256,000 jobs added in December and GDP growth of 2.3% annualized in the fourth quarter. President Trump's pledge of deregulation and tax cuts has fueled confidence over the economy. However, the president's proposal for a combination of immigration controls, tax cuts and tariffs have increased expectations of higher US inflation. And as a result of Trump's tariff threats, gold and other base metal prices increased in response over the month. Growth asset gains in Europe were driven by the solid global economic backdrop and cautious signs of progress in the Eurozone macro outlook. Retail sales came in at 1.2% year-on-year for November, marking the fifth consecutive month of growth. Whilst the Eurozone Composite Purchasing Managers Index, or PMI, crept into expansionary territory at 50.2 in January. Turning to growth asset returns, the return of President Trump to the White House, along with the America First policy agenda, has proven sympathetic for US equities. But the rise of Chinese AI, or artificial intelligence company DeepSeek, led to concerns over the Magnificent Seven's ability to deliver their current high valuation expectations. So putting this into perspective, Nvidia's market value fell by nearly $600 billion on the 27th of January. That's the largest one-day decline in US stock market history. In China, less aggressive tariff threats from Trump helped equities, along with more positive domestic economic data. Whilst Japanese equities lagged in January as the Bank of Japan announced a 0.25% interest rate hike, as its confidence in the sustainability of domestic wage growth improved. Looking at factor performance, value and momentum led the way in January, with the growth factor facing headwinds over the month. So turning to defensive assets, the US inflation numbers and the technology sell-off led to a positive response from US government bonds, and this saw the 10-year Treasury yield decline from its highs in the middle of the month. The UK 10-year gilt yield ended the month at 4.5%, sharply down from its 4.9% mid-January high, as recent data has shown the UK economy to be stagnating. So in summary, January highlighted the risk to investors, which is presented by high US stock market concentration and high earnings expectations from technology. This underlines the importance of regional divergence and emphasises our themes of maintaining a balanced portfolio and a broadening of returns as we move through the first quarter of 2025.